So here we are, up 12% from the lows in the S&P 500 less than 4 weeks ago. Still down 10%. In some measure, we've kind of just fed off of the extreme negative sentiment. Market was very stretched to the downside. Things maybe don't look so terrible. What would it take to continue this rally and prove that it's more than just a bounce?
Well, you know, I thought that January 3rd last leg down encapsulated a lot of what was going on because it was triggered by this surprise of the ISM dropping from 59 to 54. You know what?
And the Apple warning.
The Apple warning, but the 54 caught my eye because I think that was a dramatic overreaction. 54 is expansionary. And yeah, it's not 59, but it's still pretty good. And I think that's really indicative of what we likely will see in 2019. Still an expansion, a little slower. Consensus estimates, and I like to focus on top line because it's a better sort of long-term earnings projection. Consensus top line's up about 6%. I think we'll hold that. I think that'll be enough to at least get the rest of the sell-off back from the fourth quarter.
Jurrien, forward earnings estimates do continue to come down. Clearly, the early edge of the fourth quarter reports have been good enough to support the market. But we're looking at, perhaps 4% published consensus maybe for the next few quarters. How do you think the market is valued right now relative to that kind of a slowdown in profits?
Yeah, as always, it comes down to earnings and the Fed, and right now is certainly no different. So earnings estimates for the calendar year 2019 were at about 12% for 12% growth a few months ago. They're down to 7% and falling pretty rapidly, actually, about 50 basis points a week. So at this rate, we may only get into the low to mid-single digits for 2019. So this is not the quarterly number. But a lot of that decline actually is in the energy and technology sector. So maybe it overstates the severity of the erosion, if you will. But Q4 is estimated at 11%, Q1 at 2%, Q2 at 4%. So clearly earnings have slowed. The earnings growth rate from last year was never sustainable, obviously at 24%. The market needs to get some sense of where earnings growth is going to settle, and my sense is it'll be somewhere mid-single digits, and I think that's okay as long as the Fed kind of stays on hold. But even there, the debate's going to be, or already is now taking place, that it's no longer about whether the Fed keeps tightening or pauses, but whether it pauses or actually cuts rates. And so that's a whole other dimension to what we need to deal with here in terms of figuring out whether investors are getting fairly compensated for taking risks in an uncertain world. And with the PE falling 30% last year, I think that actually is the case. I do think investors are getting fairly compensated here, but clearly things are less certain than they have been over the past couple of years.
Simeon, I mean, that's the thing. If you project ahead at 6 or 9 months, right? Let's say the earnings come in as we think. Are we going to be freed from this sense that this is maybe the last gasp of this expansion, or that the Fed remains at least alert to the idea that they might have to tighten a little bit more? I am trying to figure out kind of what gets you away from this idea that this is a kind of a late cycle.
That's a good question, because I don't know that anything ever can, right?
Yeah.
Even if you say every time you see good numbers, you're going to think, okay, this is the last hurrah. This is the last hurrah. It's so long at this point that people just anticipate.
Well, I think narrowly with respect to the Fed, I think we're actually in a pretty reasonable place. We talked towards the end of last year about the notion of, maybe the Fed stops hiking but continues the unwind of the balance sheet. And that sort of sounds like where we are right now. I mean, neutral on Fed funds is probably about 3%. So maybe they just stop at 2.5%. But it's clear that we keep hearing that balance sheet is going to keep shrinking. And that could promote some normalization. So at least there's some normal powder left in terms of getting rid of the quantitative easing should we have a little bit of weakness.
Mm-hmm.
Jurrien, we were talking earlier about whether the market has already essentially baked in some kind of progress on China, or at least no further escalation. What do you think right now, roughly speaking, in terms of the Fed, trade, and all the rest of it is now assumed by the market?
Yeah, I mean, my assumption, correctly or incorrectly, has been all along that trade with China is a very long kind of containment strategy. And whether we will or will not get a deal, in the next month or so, it's still one battle in a longer war, if you will. So I'm not going to pin too many hopes on whether something gets done or not, because I think this is a much longer thing. But I do think it's significant if there is some breathing room for China to actually stimulate their economy. So everyone thinks China is doing poorly because of trade, and obviously that's a major factor. But they're doing poorly because the Chinese economy has been slowing, and the Chinese policymakers have been unable to really stimulate the economy because China is stuck with a currency that's pegged or linked to the U.S. dollar, and when the U.S. is tightening, China can't really ease because it has to import essentially U.S. monetary policy. So the Fed going on hold or even reversing, which is certainly not, I think, where the Fed is, but the market certainly is pointing that way. If that were to happen, that gives China a lot more relief to kind of reflate the economy. And so when they lower interest rates requirements, it's going to get a lot more traction when the Fed is sort of not getting in the way. So I think that's actually a more important development in terms of global growth and what's happening in China than whether we will or won't have a trade deal over the next couple of weeks.